Hey everyone, and welcome back to the channel. We all dream of making our money work for us, right? We see those headlines about explosive growth in the stock market and think, I want a piece of that. But let's be real, the thought of losing your hard-earned cash can be downright terrifying. It's that fear that stops so many people from ever starting their investment journey. What if I told you that the smartest investors aren't just focused on making big gains, but are masters at protecting what they have? Today, we're pulling back the curtain on one of the most crucial, yet often overlooked, skills in finance, risk management. This isn't about avoiding risk altogether. It's about understanding it, taming it, and turning it into your ally. Stick with me, because by the end of this video, you'll have a practical toolkit to invest with confidence, sleep better at night, and build wealth sustainably for the long haul. So, what exactly is risk management? It sounds like some complicated Wall Street jargon, but the core idea is simple. It's the process of identifying, assessing, and controlling threats to your capital. Think of it like being the captain of a ship. You can't control the weather, but you can check the forecast, chart a safe course, have lifeboats ready, and know how to navigate through a storm. In investing, you can't control the market, but you can control your strategy. Ignoring risk is like setting sail into a hurricane with no map and hoping for the best. That's not investing, that's gambling. True investing is about making calculated decisions to grow your wealth over time, and that requires a solid defense. The first step in building that defense is understanding what you're up against. Let's break down the different types of risk you'll encounter. First up is market risk. This is the big one. It's the risk that the entire market or a large segment of it will decline, dragging your investments down with it, regardless of how great your specific company is. Think about major economic events, geopolitical tensions, or even shifts in interest rates. These are the big waves that can rock every boat. You can't eliminate market risk, but you can manage it, and we'll get to how in a bit. Then, there's what we call specific risk, or unsystematic risk. This is the risk tied to a single company or industry. Maybe a company has a major product recall, a new competitor disrupts its business, or there's a change in management. Unlike market risk, which affects everyone, this is a localized storm. The good news, this is the easiest type of risk to protect yourself from, and the primary tool for that is our first golden rule, diversification. You've all heard the saying, don't put all your eggs in one basket. That is the essence of diversification. It is the single most powerful and accessible risk management tool for any investor. If you put all your money into one stock and that company fails, you lose everything. But if you spread your money across 20, 30, or even more different companies, and one of them goes under, the impact on your overall portfolio is cushioned. It's a safety net, but diversification isn't just about owning a bunch of different stocks. True diversification means spreading your investments across different asset classes. What does that mean? It means owning a mix of stocks, bonds, real estate, and maybe even commodities like gold. Why? Because these different assets often behave differently. When stocks are having a bad year, bonds might be stable or even go up. When your local real estate market is flat, your international stocks might be soaring. By owning a mix, you smooth out the ride. One part of your portfolio's IGs while another's AGs, reducing that gut-wrenching volatility. You can achieve this easily through low-cost index funds and ETFs, which automatically give you exposure to hundreds or even thousands of securities in one go. Okay, so you've diversified. What's next? The second key is understanding your own personal risk tolerance. This is a crucial, soul-searching step. Your risk tolerance is your emotional and financial ability to stomach the ups and downs of the market. Are you the kind of person who would panic and sell everything if your portfolio dropped 20%? Or can you view it as a temporary dip and stay the course? There's no right or wrong answer, but you have to be honest with yourself. Factors like your age, your financial goals, and your time horizon play a huge role. If you're 25 and saving for retirement, you have decades to recover from market downturns. So, you can likely take on more risk. If you're 60 and need that money in 5 years, your priority is capital preservation. So, you'll want a much more conservative portfolio. Aligning your investments with your personal risk tolerance is non-negotiable. A strategy that keeps you up at night is a bad strategy, no matter how good it looks on paper. Now let's talk about a specific, powerful technique, the stop-loss order. This is a practical tool you can set up with your broker. A stop-loss is an order to automatically sell a stock if it falls to a certain price. For example, you buy a stock at $100 and you decide you're not willing to lose more than 10% on it. You can set a stop-loss order at $90. If the stock price drops to $90, your broker automatically sells it for you, limiting your loss. It's like an emergency eject button. It takes the emotion out of the decision. In the heat of the moment, you might be tempted to hold on, hoping it will bounce back, a behavior known as loss aversion. A stop-loss makes the decision for you, based on the logical plan you made when you were calm and collected. It's a disciplined way to protect your capital and prevent a small loss from turning into a devastating one. Another incredibly effective strategy is called dollar-cost averaging. This is perfect for long-term investors. Instead of trying to time the market by investing a lump sum when you think prices are low, you invest a fixed amount of money at regular intervals, say $200 every month, no matter what the market is doing. When prices are high, your fixed amount buys fewer shares. When prices are low, that same fixed amount buys more shares. Over time, this strategy averages out your purchase price and reduces the risk of investing all your money right before a market dip. It's a disciplined, automated approach that removes guesswork and emotion. It turns market volatility into an advantage, allowing you to systematically buy more when things are on sale. It's a simple, powerful way to build wealth steadily over time. Finally, the master key to risk management is adopting a long-term mindset. The stock market is not a get-rich-quick scheme. Short-term trading is extremely risky and is a game best left to professionals. For most of us, wealth is built slowly and steadily, over years and decades. When you invest for the long term, short-term volatility becomes noise. A bad month or even a bad year is just a blip on a 20 or 30-year chart. The S&P 500 has experienced numerous crashes and corrections, but the long-term trend has always been upward. The people who lose money are often the ones who panic during a downturn and sell at the bottom. The ones who win are those who stay disciplined, stick to their plan, and let the power of compounding work its magic over time. Patience is your ultimate superpower in investing. So let's recap the toolkit. First, diversify. Don't put all your eggs in one basket. Spread your investments across different asset classes and geographies. Second, know yourself. Understand your personal risk tolerance and build a portfolio that lets you sleep at night. Third, use practical tools like stop-loss orders to cap your downside on individual investments. Fourth, embrace dollar-cost averaging to turn volatility into an advantage and invest consistently. And finally, think long-term. Patience and discipline are your greatest allies. Investing doesn't have to be a source of anxiety. By implementing these risk management strategies, you shift from being a speculator to a strategic investor. You build a financial fortress that can withstand the inevitable storms of the market, allowing you to capture the growth you need to reach your goals. It's about playing the long game with a smart defense. Thank you so much for watching. I hope this gives you the confidence to take control of your financial future. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe and hit that notification bell so you don't miss our next video. Do you have your own risk management tips? Share them in the comments below. I'd love to read them. Until next time, invest wisely and stay safe.